Good morning, good afternoon, good evening. It's 5:05 p.m. on Friday, February 10th, almost Valentine's Day. And welcome to the latest episode of Mark Yu and Wowie Show. How's it going, Wowie?
Doing well, Mark. How are you?
Good, good, good. Well, we're at episode 67, pre-Valentine show. Love
Mhm.
volatility, I guess. So for those who are not aware, volatility is like the up and down or the swings in stock prices and the stock market itself. So on we go. We're gonna go ahead and look at some of the weekly statistics that we take a look at to determine the sentiment of the stock market. If everybody's thinking that if it's going to go up, going down, or neutral. So this is a survey gathered by the American Association of Individual Investors. Bullish sentiment has gotten higher. So from 29.9% last week, February 1st, we're now at 37.5%, almost 10% increase in bullish sentiment. Meanwhile, there are a lot less bearish or negative sentiment out there. From 34.6, we're down to 25%. Look at that, Wowie. It's even as low as lower than the historical average. So this is, beforehand we haven't seen this data, so we're just tackling it raw in this recording. So look at that, Wowie. We're now at par in terms of bullish investor sentiment, 37 and a half, and we're even less bearish as what historical average identifies. So might be the time to think about what you've been invested in or your winnings. What do you think, Wowie?
Oh, probably a good time to take gains
Mm-hmm.
when it starts going up.
Yeah, because
Uh,
currently investors think that they're still gonna go up in next coming weeks and months. So we haven't
just
seen this.
remember, there's still projections of potential mild recession.
Right. I think Goldman Sachs have retracted their forecast of chances of recession from moderate, I think 35%. They pulled it down to 25% of recession. So the recession risk is still out there for sure.
But it's lower now. That's good.
Exactly. Yeah. The probabilities of a recession. So one thing that sticks out here is that we haven't seen this 37.5 bullish mark since the whole of last year. This is the first time that we've actually, with all of our recordings, this is the first time that the bullish sentiment have stuck out to 37 and a half, equivalent to its historical average, and the bearish a lot lower than the 31%. So quite interesting fact there. So for the volatility itself, for the past 5 days, it's been up 5%. Meanwhile, the S&P 500, the S&P 500 here, that comprises of 500 largest stocks, it's almost flat, negative 0.71% for the past 5 days. Nothing has much happened at all on a broader stock market index. The volatility for the Nasdaq, which is heavy weighted, heavy tech weighted, like the Google, Amazon of the world, for the past 5 days, it's up 2.3%. So a little less volatile for the Nasdaq. But if we're going to take a look at the Nasdaq index itself for the past 5 days, it's close to flat as well, negative 0.73%, similar to the S&P, despite a more upside of in terms of its volatility. I think it's more or less referring to the up and down swings in small cap companies like Lyft, for example, which was down big, 30, I think 30% yesterday, right, Wami?
Hmm. Yeah.
So 36% today actually. A big drop because it missed its earnings projections. And I think also it didn't meet expectations for its forecast. So not a good sign for a business model that has been having issues making any profits at all. So, and also I think in terms of its market share, it only has the United States to play with. Unlike Uber, it has other countries. In your, have you tried riding a Lyft, Huawei or Uber?
Well, my son is a Lyft driver when he was in Indiana
Oh wow.
about
Mhm.
3 years ago, and he did that stint while he was close to the university there, and I
Mhm.
think he liked it.
Yeah.
Um, but I think Uber is more diversified
Oh, for
compared
sure.
to
Yeah.
Lyft, because they have the um, delivery,
Yeah, they have the Uber Eats. Mhm.
hmm and they have freight. So that's another thing that's an advantage to, that Uber has over Lyft.
Yeah. In my personal experience, I honestly haven't had good experience. Well, most of the time, I would say half of the time, I won't have a good experience with Uber in comparison to Lyft. I think Lyft drivers take pride in what they're doing, while Uber, it's a hit and miss. Some drivers are rude, some are, like for example, they will just, you know, not even let you use their trunk to put your luggage in it, especially if you're going to the airport. Unlike Lyft, they're the ones who are gonna jump off the car. I've experienced this twice in an Uber, uh, service where they won't let me use the trunk of their car or truck. But Lyft, they
hmm
would go, jump off the car, help you pick up your stuff and things like that. Nonetheless, Uber is up as a stock 35% since the start of the year. Meanwhile, Lyft, which operates in a similar type of business, is down 7%, including its big drop today, 36% on one day. So we're going to take a look at the weekly performance of the different industries here in the US. For the past week, oh my gosh, look at this, Wawi. Are we back in the 2022 levels again? Is this a sign for the past week? It's only
Yeah, it's only energy.
only energy.
Energy is raking in the profits.
Yeah, of 4.85% as a sector for the past 5 days. Meanwhile, communication services, which has also always been tech heavy, it's down for the past 5 days. If you're gonna take a look at the biggest of the companies there at the communication service, it's Google, Facebook or
Meta.
Meta, Disney, T-Mobile, Comcast, Netflix. Oh my gosh, are we back in 2022 levels again? So yeah, this is the past 5 days, which is a little bit disappointing because I thought honestly, like there's gonna be like a change of preference in terms of market behavior. But if we're gonna take a look at since January 1st, so today's February 10th, so it's been at least a month and a half of market operations. Technology is second best performing, 14.14%, which is good, right? Um,
Yeah.
mhm.
hmm
Meanwhile,
Um,
yeah, go ahead.
and if you look at company like Tesla, it's like 100% in just a little over a month.
Yeah, that's
Um,
amazing. It just skyrocketed almost double. 82% since the start of the year, from $108 to $196 a share. That's really
mhm.
good climb. And I bet it's like part of consumer cyclical, if I'm not mistaken. Or is it?
Discretionary.
It is, yeah. Consumer cyclical for Tesla. $600 billion. So at one point it was $300 billion, right, Maui?
Yes, yes. So
Wow, double. $300 billion in gains. That's amazing. And I remember you sharing to the group that you were buying more at $100 a share. So that's
yes,
incredible
yes.
call. That's
hmm
amazing. Yep. And meanwhile, energy is down there 4.16%. So I guess this week is a one-off for energy. Kudos to energy. um,
hmm
Meanwhile, healthcare, consumer defensive, and utilities are both still on the negative territory. These are recessionary industries, which interestingly are down in the red. So people are getting more aggressive, which kind of supplements the fact in our survey we're seeing bullish sentiment that we haven't seen for the past 12, 13 months in a row.
hmm
So this is quite interesting. The fear and greed index, I believe, yeah, a week ago this was as extreme greed, and now we have we have declined a little bit, 6 points down to greed territory at 72, still at greed. So the 125-day moving average that we sometimes we closely look at, we're still up there since we've broken through back in January 19th. And meanwhile, we have discussed this previously. The longest time that it had stayed there, despite the bear market last year, was from November 9 to December 16. So about a month and a week. So far we have been in this kind of positive uptrend since January 20. So it's not even a month yet. So honestly, we may still have ways to go, despite people saying that we might experience a sell-off from here. Just barely, just looking at that period of reference. It's not a foolproof guarantee that we're still gonna climb up, but it's a good guide. I honestly, in my opinion.
Well, the economy is still very robust. If you look at the jobs report, the U3 and U6 unemployment
Mhm.
data just shows that, it's a very strong jobs market.
Yeah,
So,
right.
and the communication, the clear communication of the Federal Reserve with regards to their projected rate hikes have been very helpful for the market pricing. So I just think that they have priced it for a soft landing right now. So that's what we're headed.
Yeah. And according to the US Bureau of Labor Statistics, I mean, we gained 517,000 jobs in January, 500,000 jobs in 1 month alone. And that the unemployment rate has remained little change at 3.4%. I mean, how can we go into a recession with this kind of numbers? I mean,
The projected GDP growth is low. It ranges from 0.2 to something like less than 2% for the US, and the projected time that they're going to reach that federal fund rate of 2% would be 2 years.
mhm,
So it's going to be slow for quite some time.
right. But yeah, with those type of numbers, I don't see us like being like really in the depths of recession. I mean, the saying like they're at the tech world, the firings have been happening left and right, and it's slowly transferring into some of the big companies, the S&P 500 ones, excluding tech. So we just have to hold on to our, you know, conviction that the market would do just fine over the long term. But you know, they say like if one person, if you get laid off, I think that's a recession, and if I get laid off, and that's a depression, that type of saying.
Yes.
So hopefully everybody, try to keep their job and they be able to provide for their families. It's hard to be laid off for sure, but
Well,
not.
on a personal note,
Mm,
my son works remotely for a biomedical company, and he's a contractor,
mm,
and they're not gonna renew his contract. Uh,
mm,
so so you're seeing the pressure now for companies to save money, um, moving forward. So we're just seeing the tip of the spear on the job market. So, but they just overhired during the pandemic, but
right,
I think it's gonna reach a point where where they will have to lay off workers, and that may determine when when the Fed will pivot away from you know from continuing their rate hikes.
right. It's only a matter of time because it's hard to figure out like right now when we're gonna see that type of mania. So hopefully your son gets a good gig after this, Wowie. I'm pretty sure, with the skills he has, he will be able to transfer soon on a different type of company, much bigger company, hopefully, right? Because I think
Yeah,
the bigger
he's
ones.
looking for jobs in Dallas.
Oh, cool.
So,
Yeah,
mhm.
bigger area, bigger city, a lot of competition among companies trying to get the best employees in their company for sure.
Mhm.
So next will be the University of Michigan Sentiment Index, which climbed up on its latest reading released this morning. So we've seen the lowest of the low couple of months of the last quarter of 2022, and we haven't looked back since. So this may be a good sign in terms of consumers, despite the high inflation rate that we have been experiencing. Um, so if this continues, maybe it's one more reason to back off of that recession um, fear. And here's another chart. This, by the way, this I got from Charles Schwab research. So this is the CEO confidence survey. So believe it or not, CEOs became a little bit more bullish as of recent data. So
Mhm.
despite the recent cuts in their earnings projections, which has been happening each and every time there's a company announcing their earnings, this is the fourth quarter earnings report period. Um, they've still gotten a little bit bullish. So they don't think that we'll expect any recession, or at least in terms of this survey, which if we're going to take a closer look at, honestly, it's during the initial spike actually when we saw this gray mark here indicating a recession. So we're not out of the woods yet, despite the CEOs turning bullish. So there's no gray line here indicating recession, but who knows? We're coming off of a sharp drop last year. The wage growth tracker, which was also just recently released. So for the job switcher, so that's the only time that you get a little bump on your salary if you switch jobs to a different employer instead of staying on the same job, which barely gets up there if anything. Yours truly, myself, I haven't experienced any growth in my wage unless I do any PRN on the side. But I bet when I switch jobs, there'll be some climb, some increase for sure.
Well, in my case, my wage, my raise for the year is just 2%, and it does not keep up with the cost of living changes at this point.
True. We have
So
higher
if you're not an
inflation.
investor,
Mhm.
you're kind of left out when it
Yep.
comes to inflation.
Yeah. The trickle down economics always starts at the top, the stock market, and the hedge fund managers and the CEOs. But yeah, for our ordinary employees, yeah, good luck to us. We just have to keep grinding. And according to this Charles Schwab report, actually, we are plateauing. For those switching jobs, where it's actually falling from above 8%, now it's going down. So slowly but surely, this may also influence the inflation stuff that's happening, with less people, with less buying power, less, the Fed wants to see a higher unemployment, so less jobs. So, okay, a highlight here that was that just happened yesterday. This is a CNBC article regarding Disney and Nelson Peltz. So Nelson Peltz, a billionaire in his 80s, going into to Disney, buying a huge stake, demanding all sorts of adjustment management. So as a result, um, he then announced after Disney announced its numbers yesterday and its plan for trimming how many jobs? I think 10,000 jobs, right? Oh, 7,000. 7,000 layoffs, restructuring, um, nothing else that Nestle Pence wanted aside from that. He said the proxy fight is over. So I guess the only way to satisfy a big or huge investor nowadays is to see a lot of layoffs and a lot of cost cutting.
Mhm. Well, this may be the year of activist investing, taking over some of the major decisions for companies.
Mm. Yep.
They'll start raiding the board with activist investors.
Yes. I think that's what they just really want. Like a lot of tightening, belt tightening, a lot of layoffs. You know, it's bad for the regular employee, but in order for a company to deliver its numbers and profits for shareholders, a lot
Mhm.
less cost overhead would be additional to their bottom line. So looking to slash 5.5 billion in cost. So that's a good amount. So that definitely satisfied one of the biggest investors out there. Okay, my apologies. I think I said in a messenger that Peltz made 900 million or close to $1 billion in profit, but it looks like he made $150 million in 3 months' time of investing.
Well, that's still a big chunk of change.
Hmm. A lot of money just by buying a good amount of 900 million worth of stock, sending a letter to the Disney CEO, and then selling later at a profit. It sounds so easy, but if you're playing with billions of dollars, I mean, it's quite ballsy to do so. It's so
Mhm.
hard. Yeah. Activist sitting on paper profit after scrapping proxy fight. Stake value was up as much as $250 million yesterday. So Nelson Peltz, at 80 years old, octogenarian, still make millions and millions of dollars in whichever move he does. So equity funds. So this is the fund flow that we also take a look at on a weekly basis. This was just updated today. It says US equity funds see outflows for 12 weeks in a row. So that's pretty much interesting because I don't know why Viber is sending me messages. I guess that's spam right there. Cryptocurrency still haven't learned its lesson. So equity funds see outflows for 12 weeks in a row. That's incredible. I thought we were already turning on a positive note. So according to Reuters, investors continue to withdraw from US equity funds for 12 straight weeks. Wow, that's interesting. 12 weeks, 4 months. Investors have been pulling their money for 4 months now, since November, December, January, February. Wow.
A lot of it is going into global equity funds, looks like,
Mm-hmm.
including some of it going to India.
Yeah, we're gonna see that in a little bit. For sure, US large and mid cap funds experienced nearly 4 billion and 675 million in outflows respectively. Meanwhile, investors purchased 2.16 billion worth of small cap funds. So here we go. Financials and tech. Oh, they experience inflows of 1.2 billion and 430 million respectively. Interesting. So I thought investors were pulling out of tech, but not actually. I wonder where they're pulling their money from. But they're actually putting their money in financials and tech.
Yeah, a
And
bigger chunk of it on financials.
yeah, and look at this. US bond funds amounting to a net $2.4 billion in inflow. It's fifth week in a row. Huh. So investors are putting their money in US bond funds, financials, and tech. Taxable income, fixed income funds. Okay. I guess they're betting at the return of the bond funds since they've performed poorly last year. And look at this. Investors exited nearly 20 billion worth of money market funds. These are good as cash. These are not strict investments, not stocks, not bonds. This is the money set aside to earn a specific amount of interest with no commitment. So you can pull in and out of this. 20 billion, their biggest weekly net selling in 7 weeks. So investors are now taking a look at where to put their money to make it work harder for them.
Mhm.
Uh, Similar report, Seeking Alpha. All right, what is this? So this one is a Okay, the sentiment of the retail investor. So this is another warning shot. So in addition to our American Association of Individual Investors telling us that it's been bullish now, this one too indicates that the retail trader is optimism is back. So for the whole year of 2022, except for the little blip back in last week of March, retail traders have been very negative on the market. But this week, you see that spike. Not as That spike has not been seen since November of 2021 when we were still hitting all-time highs day after day. So sentiment is bullish right now, which for a contrarian investor, if you're doing the reverse, if you want to play the psychology of the market, then you would be probably getting a little bit defensive right now because of this concern. I mean findings. So the dumb money index, dumb money confidence. So the higher this one goes, the more bullish the dumb money is, supposedly. So dumb money referring to retail or regular investors. So this also reflects our finding previously. So we are at very high points right now, not seen since, look at that, not seen since January 28th of 2021. So
So
we're
people are taking more risk.
we are pretty much euphoric right now, for sure. A little bit of a red flag right there, for sure. A little bit of warning. We're not telling you, we're not registered investment advisors, me and Wowie, but we do this out of passion, and we're sharing factual data here. And there are some red flags showing up for sure.
Mhm.
Um,
Well, a lot of the equity stocks are still overpriced, so kind of think about it that way too.
mhm. And this is a recent Bloomberg article referring to the central banks published on February 7. Powell says further rate hikes needed and markets take heed. It may well be the case that we have to do more. So I like the word may well be the case. So there's no guarantee, but still, still tilting on that side that we may, we might do it. So
Mhm.
Powell is not done yet. The Federal Reserve is not done yet to quash, to keep raising the Fed funds rate to quash inflation. So we're not out of the woods, that's for sure. A little bit of information here since we're in the midst of quarterly reports. So for the S&P 500, these are the 500 best companies here in the United States. The worst performing earnings per share surprises among the top companies. Number one would be the worst performer is Boeing Company. They almost breached the 1,000% level, negative 985% in terms of their earnings. The second worst, wow, believe it or not, is Amazon, negative 83% in their earnings surprise. Third worst, another tech company, Netflix, negative 78% earnings in terms of surprise. So, surprise means Wall Street didn't expect this. They were surprised that the company reported such a poor earnings report or earnings number. After that, it's CarMax, Intel. I really thought Intel would be the worst, but because of its share price performance, but not really. They just surprised Wall Street by missing negative 50% of their projections. US Bancorp, Goldman Sachs, one of the largest banks here. Bank of New York, Match Group, which owns Tinder, and KeyCorp. So who are the best scorecard performing for earnings per share for the last quarter of last year? Best one is Corteva. Their earnings surprise was more than double, 208%.
What kind of company is Corteva?
I have no idea.
Let's see.
Corteva is a major American. agricultural, chemical, and seed company.
Oh, that makes sense.
It was an agricultural unit of Dow DuPont.
Mhm.
Impressive. Followed by Seagate. This is a semiconductor. So, here, Seagate, what I've observed is the next one is Lamb Weston. That's also a semiconductor, right, Huawei? Lamb Weston, is it?
I have no idea.
Lamb Weston. Oh, it's also a food processing company. Look at that. So, food
Okay.
processing company are making their mark.
Agricultural and food, which
Mm-hmm.
is,
Yeah.
what you need during a recession.
They've also probably benefited from the inflation. Didn't pass along their their earnings to their employees, rather than kept it in their bottom line to profit their shareholders. So
Clorox is up too.
Clorox, NVR, that's a property company, a real estate company.
And lumber giant Weyerhaeuser.
hmm
Oh, it's nice to see Nike in there.
Nike, Polter
Finally.
Group, Polter Group, another real estate builder. Rockwell Automation, Industrial, General Motors. Oh, General
Mhm.
Motors, a car company.
Yeah,
Surprise to the
General
upside.
Motors is doing a lot.
Hey,
Mm.
if we're gonna take a look at General Motors stock, since the start of the year, they're up 22%. Not bad.
Mhm. They have a lot of projects.
hmm And next, what if we're gonna see their earnings per share as a group, the S&P 500? You could tell for this first quarter, we're still expecting an overall decline of negative 3.3%. Meanwhile, for the last year, 2022, each and every quarter, S&P 500 recorded negative earnings growth. Wow. It's like down during 2019 and up from third quarter of 2020 to third quarter of 2021. And then it started slowing down and back to the negative. The question is, after one, two, three, four, after so much quarter of negative earnings growth, will we see an upside pretty soon on the second quarter? I don't think so. What do you think, Wally?
Well, there's downward pressure on the earnings, so
Mm-hmm.
most likely not.
Yeah.
So
Oh,
it's good to like position yourself on something that would probably be more stable for right now. I think, if you look at the global market, I think Asia will be a good place to put your money in.
right.
But that's not an investment advice because we're not, we're
Mm-hmm.
not advisors.
Right. Well, Wally, I guess that does our episode for this week. Episode 67.
Mhm. February 2023.
Yes, sir. And we'll just keep going whenever we can do a recording. For those who are listening, still listening to us, we appreciate your time, and please hit that subscribe and like button if you like what you're listening to. All right. Well, I guess that does it for now. Thank you guys, and have a wonderful weekend. Again, this is Mark Q signing out.
And Huawei Santos signing out.